Welcome to the Rosenberg Roundup. I'm Dylan Smith.
And I'm Jacob Rosenberg. As usual, we're going to go light on the pleasantries today and just dive right in. Markets took somewhat of a week off, given the fact that we've been in a little bit of what you might call a data drought lately. So I think for today's episode, we're going to have to mildly refocus our attention elsewhere. Dylan, maybe you can quickly go through what we're going to be discussing.
Yeah, well, the light data week gives us a chance to really get into the spotlight this week, where we're going to be talking about aging. The aging of America's capital stock, that is, which has pretty direct implications for investors. So hopefully that'll be interesting. But there are some international data developments worth discussing, notably Sweden following Switzerland in lowering interest rates. That's their first cut in 8 years, as well as recapping Thursday's Bank of England meeting. Of course, markets never truly get a break, so we have some commentary on asset prices, as always.
All right, that rounds things up pretty nicely, I think. Let's get going with the week in review. We left off last week talking about how a lot of the labor market indicators were softening, but we were bracing for yet another upside surprise in last week's nonfarm payrolls. So maybe that's a good place to pick back up for this week.
Well, for the first time in a long time, employment growth actually came in below expectations in the US. So we saw employment growth of 175K versus 240K expected, so quite a big downside miss. And there was a lot more weakness in the detail of the report. Overall hours worked, so that's employment plus how long employees are working for, that shrank. The unemployment rate nudged up. And overall, this was a report that was far more in line with what the totality of the labor market data are actually saying. So a pleasant coming back down to earth for non-farm payrolls.
So clearly that's going to have had an effect on the market narrative. So let's get you to break that down. What did you see?
It did lead to a snapback in expectations on what the Fed is going to be doing in terms of cuts. We now have the September cut much more likely than not. Although there's still only one total cut priced for the totality of this year. So expectations still broadly that the Fed is going to, deliver one and do it very slowly in terms of how they cut. What we saw from markets as a result was equities rallying on Friday after those non-farm payrolls and having a kind of sideways week since then. And you can put that down to, you can tell a story about how that comes down to lower expected interest rates relative to before the non-farm payrolls being a good thing for stocks. But I also would not have been surprised if the number had come in above consensus and markets had rallied on the narrative that the economy is booming, job growth is positive, and that's all good too. So we're in this kind of equity market right now. Animal spirits are so high, you might say, that most news is good news. And yet I say that against the backdrop of the City Surprise Index, which measures kind of the overall difference between what economists expect of the data and where the data is coming in, that turned negative for only the third time in the last 3-ish years. So that's a negative signal. We're seeing a bit of a growth slowdown underway in April. We saw Q1 GDP coming a little weaker, and the ISM PMI, which is a forward-looking indicator, has now shifted into contraction mode. And on the labor market side, after Friday's report, we're very close to something called the SARM rule being triggered. That's basically a measure of unemployment rate growth that once it crosses a certain threshold tells you that we're basically in a recession, and that's getting close to that threshold. So there's a real risk, I think, that we're sleepwalking into a big slowdown that markets are totally unprepared for. And just to point out, after that non-farm payrolls report, the Fed's commentary was pretty mixed. We had a few members come out and say, clearly high rates are actually working, but others saying, not high enough and we're not seeing what we want on inflation. So they came out dovish on balance, I would say, which didn't really help kind of amplify the effect of that report.
So let's shift gears and let's take a look at Europe. Looks like there's an easing cycle taking hold over there. You mentioned earlier that Sweden cut rates for the first time in 8 years.
That's right. They managed to go all the way from rates of negative 0.5% to plus 4% over the last 8 years without a cut in between. But now they're finally easing. And that makes the Riksbank, the Swedish central bank, the second of the smaller peripheral European countries to cut. The other one, of course, being Switzerland. I'm half Swiss, but I'm frequently accused of being half Swedish. And the central banks here aren't really helping out clear up the confusion with those two banks being the first to move and kind of copying each other.
Let's get you to comment on the takeaway, though. We're discussing two relatively smaller economies, so...
Well, that's true, but both are very, very tightly enmeshed with the broader European economy and the euro area in particular. And they don't like to deviate too far from where the European Central Bank is, because that has big impacts on capital flows and on their exchange rates. So on the margin, you can read these smaller countries kind of pulling the trigger as pointing to coming ECB cuts. Although it's not really like we needed the signal, ECB President Lagarde has basically told us that they're open to a cut, and we're looking towards that June meeting as being possibly the first time that they do reduce rates in a while. But the other thing that these two banks cutting signals is that it confirms the monetary policy divergence narrative that's now in full swing. Confirms that that's a reality versus the Fed, reflecting the underlying differences in those economies. The U.S. economy has been growing faster than most of the rest of the world, and inflation has been slower to fall in the first part of this year. So that's a real divergence, which necessitates a actual divergence in interest rates too, and we're seeing that play out.
Let's also get your comment on the Bank of England. They had their meeting on Thursday.
Yeah, so they didn't cut, and that was no surprise. No one was expecting that, I don't think. So what we were all looking at was the guidance for when they might start to cut, especially with that Swedish easing in mind. The nice thing about the Bank of England is that they're very transparent. They publish their voting record by member. And what we saw was a shift from one vote for a cut last meeting to 2 votes for a cut this meeting. Out of the 9 members, everyone else was on hold. But, that was sort of engineered to send a dovish message to markets saying that, the MPC members are lining up behind a cut soon. There was also some dovish commentary in the statement, which referred to, aggregate supply growth outstripping demand, inflation expected to come down to target this year and remain close, labor market loosening, and the governor sort of struck a broadly optimistic note in his comments. So we think they can go as early as next month, although that will depend a bit on what happens on inflation and wages in the meantime, especially on services inflation.
So let's look ahead to next week. It sounds like we're going to be back to our regularly scheduled programming on the data front.
Thankfully, yes. We'll have a lot to write about next week. We've got the UMISH consumer sentiment data coming out actually later today. But the big ones next week are going to be CPI inflation and the retail sales report. So lots to review ahead for us.
Well, while I know we're excited for what we might get to comment on in next week's episode, let's just recenter today's discussion on our Spotlight, which you mentioned is going to be on aging in America. So what did you mean by that?
Well, there was lots to choose from as always this week. We've continued all our writing about economic slack that's beginning to open up on the supply side of the economy and is pulling down on inflation in the medium term, we think. And our colleague Bhavana had a lovely piece on why she thinks Hong Kong's Hang Seng equity index is looking very appealing at current pricing. But we've all become quite fascinated at the moment with the aging of the US capital stock and the thematic implications that has for markets. So that's where we decided to focus today.
So just to clarify before we actually jump in, are we talking about public capital stocks? So including, say, roads, bridges, even ports. There seemed to be a lot of panic around the aging US infrastructure being a big motivation for Biden's administration spending plans.
Well, that's true, but that's not really what we're going to focus on. I mean, it is definitely the case that we've seen a big boom in construction around utilities and manufacturing hubs. And that's one of the hottest parts of the economy right now, actually, with all the funding available through those programs. But I'm talking here about private capital stocks.
Okay, so what would that include then?
So that's houses, that's planes, trains, and automobiles, everything that is not owned by the government, but is a big capital expenditure. And all of those things that I've just listed are actually getting to record average ages. So they're as old as they've been, in some cases since the post-war period, when there was a series of long years of underinvestment through the Great Recession, or the Great Depression, rather, and through the wars, and then a big post-war boom, which de-aged everything. We're now seeing that all re-aging to those levels and beyond. So here are some stats to kind of bear that out. The median house in the US is 40 years old, and more than a third of the entire US housing stock was built before 1970. Now, to listeners sitting in Europe, that might not seem that old, but that's as old as it's ever been in the US, and US houses are not constructed out of 18th century stone. So They require a lot of upkeep given that level of aging. But the average age of home renovations, which are separately recorded by the BLS, is a record 19 years. So even the facelifts that have been made are out of date. Meanwhile, the average age of cars and trucks is a very old 12 plus years. If you think of what constitutes an old car in your household, I'm sure 12 years will be considered fairly old. So while there have been obviously quality improvements which have allowed cars to run for longer, that is a very old age indeed, and the fleet is due a renewal. And the same goes for airplanes, where COVID-19 wreaked absolute havoc with the replacement cycle around US airplanes. Everyone essentially went into maintenance mode and kind of stopped buying new ones. Now that air travel's really picked up, anyone who's flown recently can attest that, these planes are feeling pretty old. So we know that there'll need to be some replacement cycle there.
I also assume there's going to be some investment opportunities here.
Absolutely. So we're actually highlighting this as an important kind of medium-term investment theme that's going to put a lot of wind in the sails of certain bits of the equity market. Right? It's not completely straightforward because obviously there's other things going on, and some of these industries around construction and maintenance, renovation, capital goods tend to be quite sensitive to high interest rates as well. So that's a short-term hurdle in some cases. But the industries we think are worth investors investigating, and which we really like, include construction materials, construction engineering firms, equipment and machinery, and then the aerospace and defense sector. Although the stock in that group whose planes keep losing their doors might be one you want to stay away from.
Okay, I think that's a good stopping point for today. Dylan, always a pleasure getting to talk to you. Thanks for your time. To those who are still listening, thank you so much for sticking through to the end. We highly encourage that you send us your thoughts and suggestions for the podcast to our email. It's information@rosenbergresearch.com. So if you have any comments, please send them in. It's all in the spirit of making this podcast dynamic and informative. So thanks so much.
Thanks, Jacob. And with that, I am Dylan Smith. You're Jacob Rosenberg. And that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.